Good morning, ladies and gentlemen. On behalf of the management of Dabur India Limited, I welcome you to this conference call pertaining to the results for the quarter and financial year ending 31st March 2018. We have present here Mr. Sunil Duggal, CEO Dabur India Limited. We also have today with us Mr. Mohit Malhotra, who has recently taken over as CEO India Business. In addition, Mr. Lalit Malik, Chief Financial Officer, is here. Mr. Ashok Jain, Vice President, Finance and Company Secretary, and Mr. Ankush Jain, Head Financial Planning and Analysis, is also present in this call. We will now start with an overview of the company's performance by Mr. Duggal, followed by a Q&A session. I now hand over to Mr. Duggal. Thank you.
Thank you, Gagan. And good morning, ladies and gentlemen. Welcome to Dabur India Limited's conference call pertaining to results for the quarter and year ended 31st March 2018. On comparable constant currency basis, consolidated revenues from operations grew at 11.1%. Domestic FMCG business like-to-like growth of 10%, driven by strong volume growth of 7.7%. Consolidated profit after tax reported growth of 18.9% for the quarter, with operating margins increasing by 140 basis points on a comparable basis. Healthcare and HPC verticals performed well during the quarter with strong volume-led growth. Healthcare vertical reported growth of 11.2%. Health supplements grew by 14%, led by strong double-digit growth in both Chyawanprash and honey. Market shares in both categories reported an uptrend. Dabur Honey continues to ride on its strong brand equity and higher investments, which are adding to its momentum. Digestives category recorded 7.2% growth on the back of good growth in Hajmola tablets. New variants, focused market inputs, and distribution expansion have enabled the brand to enhance visibility and ranking in the most trusted brand survey by brand equity. OTC and ethical grew by 8.8%. OTC products such as Honey Tusk, Madhuvani, and Dashmola Resht Asaf posted good growth backed by marketing initiatives and activations. The classical ethical portfolio also grew at a good pace, led by medical marketing initiatives and on-ground activations. Home and personal care vertical posted growth of 10%, led by strong performance in hair care and oral care. Oral care category grew by 11%, with growth of 13.7% in toothpastes. Red franchise continued to perform well, driven by increasing penetration, aggressive marketing, and visibility initiatives. Red Gel, which was launched in 2017-18, recorded good sales in the first year of its launch. Overall share in the toothpaste category continued to increase YOY. Hair oils category registered growth of 8.8%. Sarson Amla, Brahmi Amla, and almond hair oils performed well. Our volume market share in hair oils category expanded by around 60 basis points during the year. Shampoo posted a robust performance, growing at 31%. The brands were supported with focused marketing activities and above-the-line spends. The shampoo portfolio is seeing a good response from consumers post the relaunch and will continue to position the brands on the herbals naturals platform in this category. Home care had a muted performance this quarter due to moderate performance of Odomos on account of relatively lower incidence of mosquito-borne diseases and lower institutional sales. The air freshener brand Odonil and toilet cleaner brand Sani Fresh reported good growth. Skincare registered growth of 8.5%, driven by strong performance of the Gulabari portfolio. Gulabari brand has been a steady performer and is also increasing its penetration in both urban and rural markets. Foods business had a moderate quarter, mainly on account of increased competitive intensity from value players and enhanced promotions across the board. So although sales growth was muted, profitability margins in foods saw a good improvement on account of network optimization. Various strategies are being adopted to counter competition, including aggressive media spends, tactical consumer promotions, and sampling. The fruit drink sub-brand Coolers has been launched to participate in the larger fruit drinks market. International business reported a constant currency growth of 16.8% during the quarter. GCC markets posted a strong revival with 51% growth, led by Saudi Arabia, which grew by 82%. Egypt market continued to perform well with growth of 38%. Currency translation impacted top line to the extent of around 1%. However, this impact is reducing as currencies are becoming comparable to last year. SAARC business also posted good growth, led by Pakistan and Nepal. Consolidated operating profits increased by 16.2% and operating margins expanded from 21.8 to 23.9%. If we exclude the GST impact, improvement in operating margins was around 140 basis points. A&P spends in the domestic business saw a like-to-like increase of 19.1%, while on a consolidated basis, there was an increase of 10.8%. Promotional expenses have come down significantly in line with our stated intent. SG&A expenses reflected some savings on account of cost synergies. PAT reported growth of 18.9% in spite of higher depreciation and finance costs. The company has proposed a one-time special dividend of Rs 5 per share, besides the final dividend of Rs 1.25 per share. This will entail an additional payout of around 1,000 crores to the shareholders out of surplus funds in our balance sheet. We will still retain around 2,000 crores of net cash in our balance sheet for this payout. After the GST implementation, the trade channels have seen some disruptions which seem to be stabilizing. We are seeing good offtakes in the rural channels, cash and carry, and organized retail. The year threw up multiple challenges both in domestic and overseas markets, which have been managed well, and the year has ended on a positive note. Going forward, we'll continue to invest strongly in our brands, distribution, and infrastructure to continue to grow ahead of the market and enhance shareholder value. With this, I now open the Q&A and invite your questions. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manoj Menon from Deutsche Bank. Please go ahead.
Hi, Sunil and team. Congratulations on an excellent set of results. A couple of questions to begin with. One, just taking a step back, we have seen a significant sequential improvement in your performance over the last 6 months or so, which is very heartening. Well, I understand that it's very difficult to, let's say, look at what are the micro drivers and what's the macro drivers. How much of this you would attribute that to the activities by the company, and how much would be, let's say, a general rural recovery, etc.? Or put it the other way around, if you could just help us understand some of the key pillars of your micro activities for the medium term, which you are implementing currently.
In the large HPC categories, oral care, hair care.
Sorry to interrupt you, sir. May I request you to repeat yourself? We lost the audio for a few seconds. Thank you.
Okay, to repeat myself, Manoj, there's been very little tailwinds from the macros, quite frankly, as we speak. Category growths are still trending in the mid-single digits, at least for the large HPC categories, oral, skin, hair care, etc. There's been some uptick in March, but the fourth quarter has been fairly subdued, 5-6% growth. So obviously, our growth, I'm talking about volume growth here. Our volume growths, which are trending at around 7-8% in these categories, have come on the back of market share gains. Now, having said that, we do expect the category growth to trend up. Now, while this may not be a certainty, but there are indicators, especially in the form of the monsoon, which early trends indicate a normal monsoon. Also, stimulus, which we think will happen closer to the elections. These should provide some momentum in terms of category growth, but the last 3 quarters' performance, especially this quarter and the last, has been on the back of our own initiatives rather than on any support from the macros.
Understood. Now, allow me a statement and just tell me whether it's right or wrong. Would it be fair to say that, Patanjali was more of a distraction and not necessarily a disruption over the last couple of years?
Well, it's easy to say that in hindsight. At that moment, it was a disruption, and we had to deal with it. We had to take appropriate action to mitigate it. But the action which we have taken has proved successful, mostly in the case of honey, the pricing corrections, the other marketing activities, etc., led to strong growth, 20% plus in the last 2 or 3 quarters in honey. So we have fully recovered the share. So we can't assume that this is a distraction and it's a wind which will blow over and things will come back to normal. We have to take preemptive action and make sure that our long-term brand strengths are not compromised. So that's the way we looked at the Patanjali thread.
Understood. Secondly, on the drinks business, I remember reading some comments in the media in the last couple of months, about your foray in a bigger way into the drinks market, which is honestly extremely heartening to see because a large company, looking to enter a large category. How do I think about, how we're going to address this drinks opportunity? The fruit drinks.
But I think I keep cautioning our marketing team that not to be totally distracted by the drinks opportunity. It is ultimately a low margin and a slightly more commoditized space. Our focus should be firmly on the value-added segment. But this is a segment which is too big to ignore. So, and we do have adequate amount of surplus production capacities to meet demand in this segment. So we should not ignore it. At the same time, we should not be totally enamored of this and take our eye off the main real and real active franchises. So this will certainly add momentum into our top line, into our overall market shares. But the real prize is, like I said, at the value-added segment.
Understood. So would it be fair to say that it's tactical for the time being and which can potentially become strategic at some point?
Yes, I think you put it rightly. It is tactical as we speak and has the potential to become strategic, or it may remain tactical. I don't know at the moment.
Understood. And one very last question on the international business, if you could help us understand the big volatility in the performances of one-offs, distributors, etc. there. Secondly, how do I think about the medium-term constant currency growth opportunity which you can drive organic in the international part of the portfolio?
I think the recovery in international has been the key highlight of last quarter's performance. 18% top line and around 34% bottom line is a very, very strong set of numbers. Perhaps the base, of course, is on the lower side, but nevertheless. I do think that double-digit growth in international business this fiscal is something which we are pretty sanguine about. And there would be margin gains also unless the currencies depreciate further. Fortunately, we're seeing a fairly stable scenario in terms of currency. And the overall oil economy also seems to be trending up. So there are some tailwinds there which we should capitalize. The overhang of Namaste North America, which should be behind us this year, we should definitely grow in Namaste. I do not know how much, but growth should come back after 2 or 3 years of decline. So these are multiple tailwinds which will help us. Of course, there can be events which are beyond our control, which are largely political and economic in nature. But if those don't happen, I think good growth in international business is definitely visible to us.
Thank you. Thank you, Sunil and team. I'll come back in the queue.
Thank you. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good morning.
Good morning.
My first question's on what would be a good level of growth for Dabur's domestic business. So clearly you've seen a tick up in this quarter, but would 8% sort of level, is that something you'd be happy with, or would you expect that growth to be sort of in double digits as we saw in the previous sort of rural cycle?
We are pitching internally at around 10%. Now, like I said, we do have visibility of around 8 to 10% in the first half. The visibility in the second half is quite frankly not there. But in case category growths trend up to the high single digits or thereabouts, then I think we can do a low double-digit growth in the second half, so the aggregate growth come to 10. But that's what the internal thinking is, and that may or may not happen, depends upon how well the disposable incomes in rural households trend up. At the moment, they're very stressed. And like I mentioned earlier, the category growths are still not showing any big signs of revival. There are few green shoots in the month of March, but still they are trending at around 5-6%. And we need to the category growths have to trend up to perhaps 8 to 10%, maybe at least 8% for us to grow in double digits. So that's the situation, and we believe that we should be able to do better than the last couple of years by a wide margin. But will we be able to get to double digits is not to be taken as a certainty.
I understand. Fair point. And secondly, you mentioned that you've done very well in coconut oil. Now, has this come from sort of market share gain from the market leader, or is this you sort of gaining share from the loose oil or unorganized segment?
Yeah, we have gained share. Our coconut oil franchise, particularly the Anmol franchise, is doing extremely well. I think we have done a high level of activations in a fairly stressed scenario. So that's an area where we see consistent growth happening because it's a large pool to fish in. So it will definitely buttress the top line. And the good thing is that even in perfumed hair oils, our market shares are now not just stabilized. They have stabilized a couple of quarters ago, but now they are trending up. And that's something which is very welcome. So, in fact, our biggest share gains have been in perfumed oils.
Understand. And on perfumed hair oils, is this a function of sort of the price table being normalized for the whole segment, or is it that you have offered more promotions or discounts on your?
Well, the whole category has benefited from GST, so there's been higher promotional activity, and thereby we've also participated in that, and that has been one big reason in terms of the higher levels of growth. We've also been far more aggressive in driving the lower-priced portfolio, Brahmi and Sarson Amla, which is now a very significant part of perfumed hair oils, and that's been another driver of growth. But even brand Amla has stabilized and now is showing far more consistency than before.
Understand. That's very useful. And just one last question on honey. Would your sales be back to where they were before the disruption, or is there still something?
Yeah, honey share data is not really, there's no syndicated data, so we have our own internal sources. We are pretty close to where we peaked earlier. Not quite there. I think there's still around 4-5% erosion from the peak levels. But I'm pretty optimistic that in the next 2 quarters we should get back to our all-time high levels by a wide margin.
Understand. And this was on absolute sales, or you were talking about market share?
No, this is tertiary sales, consumer household panel data. So this is actually very high-quality data, but it comes with a bit of a lag. So even that 5% erosion is actually a situation around, 3-4 months old? 3-4 months. And as we speak, and the data will come soon, we may have actually regained our entire lost share. But like I said, the numbers are a little bit dated.
Okay. All right. Thanks a lot for that.
You're welcome.
Thank you. The next question is from the line of Lalita Chopra from JP Morgan. Please go ahead.
Yeah, hi everyone. My question, the first one is on margins. Clearly this quarter saw significant beat on account of mix and cost. Do you see potential for further improvement here for the domestic margins in the backdrop of input cost inflation inching up, or probably the need for more brand investments?
If you take domestic margins, I think at the EBITDA level, we would probably have stabilized. We're pretty happy with the current EBITDA levels, and we obviously would enhance the promotional intensity in the year going forward. So that won't help. But at the same time, I think there is pricing power available now, which will help us mitigate the higher A&P costs. So broadly, we are seeing stable margins coming out of the domestic business and improved margins coming out of the international business. So the blended margin scenario, I'm talking about the EBITDA now, that should improve, even though the improvement may not be very dramatic. And remember, we've just paid out, or we will be paying out in the next month or so, subject, of course, to the ratification by in the AGM of around 1,100 crores of cash to shareholders in the form of a special dividend. So that will, to some extent, reduce the non-operating income. But at the EBITDA level, I think you should see fairly consistent levels of delivery in the domestic business and better in the international.
On pricing, have you initiated any price increases on account of raw material inflation in any of the categories?
Yes, I think we have price increases in several categories, but they've been not very dramatic. Small increases we've done. Wherever there's been some margin issues with regard to the COGS, coconut oil, for example, we've done. Odonil we've done, actually. Because the oil, that's related to the oil table, glucose. So wherever there has been some inflationary impact, we have taken up prices. It's not been very dramatic, but going forward, I think if inflation kicks in higher, especially with the oil table, at $70-$75 levels and perhaps trending higher, then we have the pricing power today to take up price increases. So that doesn't worry me. I think we should now, after a couple of years, be able to use pricing as a tool to not just mitigate, but even perhaps enhance margins.
Sure. The second question was actually on juice segment. Clearly you have to still firm up your strategy on the drink side, but on the value-added premium juices, clearly the competitive landscape is getting tougher. Does that mean, there is a need for more promotions from your side, and does that put your margins at risk? And, you mentioned about certain initiatives you are taking to mitigate these challenges. If you could elaborate more on them. And is there a way for this category or division to go back to low to mid-teens kind of growth anytime soon?
Yeah, I think we are looking at double-digit growth, perhaps in the low double digits, but that is really the endeavor which we are looking at. And obviously we will have to enhance the proportional intensity considerably, which we already have done, by the way. So you will see the back of that in the first quarter. Fortunately, the margin profile in juices is actually pretty favorable because the material costs, sugar, etc., have come down considerably. So that enables us to pump in more money to support the brands without having any dip in our operating margins. So I think this competitive intensity which is there is perhaps almost at an unsustainable level, because the margin profiles in juices never supports very high promotional intensity. There's a lot of private equity activity here, and also one of the new players has become very aggressive. But we've seen this before, and I'm not overly worried. I think we have to be consistent in delivering high-quality products at a reasonable price, and we should be able to get back into double-digit growth sooner rather than later. Of course, a lot of it will depend upon how summer is, and also in terms of how the overall disposable income story plays out, which is true for every category, but particularly true for beverages, which is a little bit more discretionary than the staples portfolio which we have.
Sure. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Vivek Maheshwari from CLSA. Please go ahead.
Hi, good morning, everyone. My first question is on the A&P spends. Mr. Dugal, you mentioned 10%, I think, at console level and 19% at standalone level. So the difference between reported and what you mentioned is just because of GST?
Yes, it is primarily because last year we had service tax included, which now for GST it is part of balance sheet. So primarily it is on account of that.
And this is just advertising. It doesn't include promotion which gets netted off against revenues, right?
That's right. Under the index, this has to be netted off from the top line.
Okay. That's one. Second, in foods again or juices again, where is the market share now compared to what it was, let's say, last year?
Well, on a YOY basis, there has been a 2% decline from 56 approximately to 54. It's not a very serious erosion. These things keep happening, so it's not something which worries us too much. I think it is on account of the disruptive competition. And also, certain brands which were earlier categorized under the drinks space have now moved into JN, and I don't really know why. So which has meant that the category size has improved, has been enhanced, because just of this reclassification, and that partly is leading to a little bit reduction in our market shares. But I think rather than hanging on to these 55, 60% market shares, which is never going to be easy when you have a dominant share, predicting it is always going to be an uphill task. We would look at seeing consistent double-digit growth happening in our portfolio. That is really a bigger challenge than just sticking on to market shares. As the case with, say, brands like Chyawanprash, the market shares are less important than how we grow.
Right. While we see a decline in market shares of about 2% in juice and nectar market, but if you look at the larger pie of J&SD market, which is juice, nectar, and still drinks, our market share is very consistent of 10% levels. Two new players entered the juice and nectar market, which is Aloe Fruit and Pran Fruto, which are the ones who've actually taken share at an economy price point, at a drink price point. So if you look at the larger pie, our market share is pretty consistent.
Okay. But just a follow-up on that, you mentioned about, all this competition, everything. But despite that, the margins have improved quite a bit. In fact, highest in the past, 12 quarters or so. In the context of competitive landscape with ITC also aggressively pushing its portfolio, what explains this margin expansion then?
Yeah, one of the reason is that we have optimized our networking with regard to manufacturing, where we are manufacturing more in India, and therefore the cost optimization has helped us to improve margins, besides the inflationary pressure on sugar, etc., eating out. So these are the two.
Yeah, but to further follow up on your question, there could be a little bit of trending down of margins in the first quarter and perhaps going forward. Because we will be increasing the promotional intensity. But like I said, that's a necessary condition to defend share. And since we are already on pretty decent operating margins, we don't mind sacrificing a bit.
Sure. And last bit on the overall margins, we have seen, and I know this has been asked before, but Mr. Duggal, your let's say, guidance of a margin, a stable margin in India business and a slight increase in international. I mean, let's say Brent is $70 or above $70 now, so which is going to impact your key inputs over the next, let's say, quarter or so. What gives you confidence on the margins at this point of time? Is it just that, there has been such a big lag on price hike and that's why you're more confident about it?
Well, there are two elements here. One is the gross margins, and I'm pretty confident that we'll be able to maintain our gross margins because of price increases to mitigate the inflationary impact. Now, having said that, there will be also pressure in terms of our SG&A because of higher outflows on account of salaries, etc., largely on account of stock options, which we have adjusted this year, and where the payout was comparatively muted in the previous year. So there will be some increase there, which will be visible. And that, I think, we can mitigate through operating leverage and through other cost reductions. But the gross margin line, which is really related to material costs and inflation, we should be able to stabilize at current levels on a YOY basis at least.
Okay, because, in the last 2-3 years, you have actually, improved your margins in a regime where input prices were so benign. So when input prices are reversing, it's quite interesting to, note that you are gunning for at least maintaining the margin or even slightly expanding it. What would worry you?
We won't expand it in the domestic business. Expansion will come from international, so the blended margins may look better, but that's a different story. I think domestic margins we should be able to protect. I don't see any great possibility of increasing domestic gross margins, but we should be able to protect because our price increases have been very muted over the last couple of years, and there was also the anti-profiteering issue which didn't enable us to take up prices. With that behind us now, I think the price increases will happen. So I'm pretty confident that will not be a headwind.
All right. On this positive note, thank you very much and wish you all the very best for next year.
Thank you.
Thank you. The next question is from the line of Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks and congratulations on very good set of numbers.
Thank you.
Firstly, on the oral care business, now clearly the good performance has continued even in this quarter. But if I compare it with the last 3 to 4 quarters, there has been some tapering down of the growth. So is this the impact of the market leader stepping up on the herbal side?
No, not really market leader stepping on the herbal side, but let's put it this way. There are 3 brands which we have in oral care. There are the 2 premium brands, Red and Meswak, and then there's the discount brand, Dabur. The premium brands continue to grow at almost at 20% level, so there's no issue there, and that's the good part. The not so good part is that the discount brand, Dabur, which is actually delivering pretty good performance over the last 3 or 4 quarters, is now beginning to flag a bit because of very high levels of competition at that price point where it exists. So that's really the reason why the blended growth have perhaps come down from, say, 17-18% to 13-14%. It's largely on account of the discount brand. But the quality of the growth has been consistently good. The high margin brands have done very well. And of course, the tooth powder brand, which is a bit volatile, and I think did provide some support last year, hasn't done particularly well. 3.9% decline. So that's been another issue. But I think if you take the overall quality, like I said, of growth, it remains consistently high.
Sure. And even on a sequential basis, the market share gain is there because you mentioned Y and Y. Okay, great.
The gains in the Red franchise and Meswak, particularly Red franchise, are high. Dabur is probably flat or maybe even small deceleration in terms of market shares. But overall market share growth has been there.
Sure, sir. And secondly, you mentioned that one of the reasons for the gross margin expansion was a better product mix. Just wanted some more details on the same. What are the better...
Well, broadly, the biggest cut is that the juice portfolio, which is lower delivery in terms of EBITDAs, has come down in terms of growth, and the higher margin HPC have grown in double digits. So the quality of growth has improved, and that has lifted the whole margin table.
Okay, sir. Thanks a lot. That's it from my side.
You're welcome.
Thank you. The next question is from the line of Anubhav Sahu from MC Research. Please go ahead.
Hi, sir.
Hello.
Hello. This is Anubhav. I wanted to comment on the competitive landscape per se. I know partially you have covered this, but to put that into context, last year there's an understanding that the companies which were good to adapt with the distribution strategy, they have gained well. And secondly, the unlisted player, which was seen as a big threat a year before, there's a complete silence for the last couple of quarters. And thirdly, Dabur itself has been a kind of a disruptor on price points of few of the categories. So wanted your view on that, how we are now pushing Dabur, whether it is a value player in some way or it is going category by category, and how do you want to spell out the medium-term strategy? And how is the competitive landscape you're seeing from the unlisted players?
See, Patanjali was the single big disruptor over the last couple of years. Otherwise, there was nothing much which our regular competitors were doing. Of course, I'm not saying the competitive intensity was low, but it wasn't disruptive in nature, with a couple of small exceptions. Patanjali changed the whole nature of the game by coming in with a lot of momentum. And that, I think, was the single biggest reason that many of our categories grew at a much lower pace than normal. Of course, there was also the other overhang of GST and demon, etc. Now, with all these three headwinds now, well, I wouldn't say disappeared, but muted to a very large extent, we should see better growth happening. And that's why, last 3 quarters have been pretty consistent. And even on the higher base, which will begin from this year, we should be able to see much better growth happening. But the key driver here is rural, and we need to have better growth coming out of that, because keep in mind that the category growth, if you take the Nielsen numbers, are at pretty low levels. They are in the mid-single digits for the non-food categories at least, right. And that's not very encouraging.
Right. And so you mentioned that rural growth this quarter has been 3 to 4% above the urban one. And,
yeah,
how has been the special distribution for that?
Well, you see, the urban growths have been at around 8%, rural at around 13%, blended 10%, and so rural continues to drive growth, and I think it's largely on account of our preemptive measures for distribution, which I have articulated earlier, that has led to this strong double-digit growth in rural. There have been other headwinds in urban, like the canteen stores continues to underperform. I think we declined, 5-6% in the fourth quarter. So that's been a bit of a headwind. Some of the enterprise accounts also didn't do well because the whole economy was under some stress. So rural is really the bastion which we have, and I think going forward it will continue to grow well ahead of urban. We still do not know when the CST issues will lapse. We hope this year will be a much better year for CST, but there's no guarantee. So rural will have to perform, and I think we have all the ammunition in terms of distribution, in terms of products. The portfolio is now very much geared to service the rural consumer, and any improvement in disposables, which I believe will happen, should fuel the rural consumption even to much higher levels.
Right. And so my last question is on Odomos. Last quarter also there was a weakness there. So is it just a seasonality thing, or do you think there's something structural happening in this category?
No, it's not structural. There's nothing structural. It's a great brand, I think, but its use is fueled by epidemics more than anything else. I think when people get this scare of dengue in particular, that's when they actually, get out of that inertia of not using it into actually buying the product. And, fortunately, in many ways, that has not happened, but it does have a negative impact on this brand.
Okay. Yeah, that's great. Thanks a lot, sir. Thank you.
Thank you. The next question is from the line of Nilesh Shah from Morgan Stanley. Please go ahead.
Thank you. So my question is, again, unfortunately, on margins. You have mentioned last quarter that you're looking at improving your market shares across the board, irrespective of what happens to the category growth rates. And I thought that would be driven by a number of interventions from your part, pricing, promotions, ad spends, new product launches, etc. And then when we talk about gross margins and EBITDA margins, as you've commented for fiscal 19, it appears that you're again slowing down on an NPD pipeline. Would that be a fair assessment?
No, not really. I think NPD pipeline is much stronger than you would see the past 2 or 3 years. Now, having said that, we will not go pell-mell into NPDs, at least the high-cost NPDs, till we see visible signs of demand revival. So we are putting some of those initiatives on hold till perhaps the second or third quarters, and then we'll take another view. But irrespective of that, the ones which we are committed in terms of GTM are much more than what we've done in the previous 2 years. And there will be some pretty interesting initiatives which we'll put into play. But how much of that we do depends upon the demand cycle. And there's no point in swimming against the tide. If the demand cycle remains subdued, the chances of new products managing to get to market is that much lower.
Is this a shift from what you had anticipated last quarter?
Well, if you wanted to give you a frank answer, I think the category growths in the last 2 quarters have disappointed. They trended up pretty steeply around a year ago, and then for some inexplicable reason, they have trended down. So perhaps it's a sign of, consumption stress, which has been there. Now we really are seeing that the cycle perhaps has bottomed out. March was a little bit better, nothing spectacular, but we did see some green shoots in March. And this trend could accelerate. It's anybody's guess that whether this will get back into, say, the high single digits from the mid-single digits category growth, or whether they will remain at this level or perhaps even decelerate. But if they do, then I think the need for market share gains would be perhaps a little bit less, because the tidal wave of growth will carry us forward, and we'll be able to capture better margins. But if it doesn't, then I think we will have to get into this slugfest of market share gains, which comes at a cost. And that could have some negative impact on margins. I don't know how much. So again, it's a question of, like I said, how the whole consumption space performs in this year.
So just to clarify, when you're saying that you're expecting margins to be flattish in the domestic business at the EBITDA level, that is assuming some pickup that happens at the category growth levels. And
yes,
you're saying
it assumes a reasonable pickup. A very high acceleration in terms of growth could see margin expansion. A deceleration of growth could see margin contraction also, because our investments will then have to continue. So it's like I said, it's very hard to forecast the scenarios. There's too many moving parts here. But I remain far more optimistic of this year than I have been over the last 2 years or even 3 years.
Sure. And final question is on your new product launches over the last, let's say, 18 months or so. Could you call out 2 or 3 of them that have been reasonably successful?
Odonal Zipper, Red Gel, your Brahmi Amla. I think all of these not had any real failure, because these weren't very high-impact launches, but all of them have done quite well. So,
and now
but like I said, last 2 years we've been fairly muted in terms of how much we invested in NPDs, and now we are beginning to open the purse strings. We just want to wait another quarter or so to see how the demand revives, and then you will see far more action on this front.
Sure. And are all these pan-India? For example, Red Gel, is that pan-India now?
Red Gel is pan-India, so is Zipper. Brahmi Amla is more of a North and West Indian initiative, but mostly pan-India, but some of them do have a regional context. So their relevance is in that region and not perhaps in, say, South India.
Sure thing. Thank you very much. All the best.
You're welcome.
Thank you. The next question is from the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, good morning, everyone, and congratulations on the strong numbers this quarter.
Thank you.
So if you can just give us some idea about the oral care as a category growth, and how do you see this the growth difference between the Ayurvedic and natural segment and the other segments?
Well, I think the natural space continues to grow ahead of the overall space. Whether that trajectory of growth is as high as it was 1 year ago when Patanjali was driving most of that growth is yet to be seen. So I think there'll be some moderation in growth. So, but then for us, we have another pool of competitive space to feed from, and I think that's very positive. So for us, I think the situation today is actually pretty benign. So earlier on, we were really getting our market share from the traditional players. Now we can get it even from the other herbal players. So there are two streams where we can feed on.
So in that context, do you think that the growth rate in the toothpaste segment can taper down what we have seen in the FY18? Or you think that there can be enough
for us? No, I don't think so. I think our growth will continue to be in the well into the double digits. So I don't see any tapering off. Like I said, we have now another avenue to attract consumers from. So that gives us a big pool to feed from. So for us, I think the situation is quite benign. But overall, the herbal trajectory may be slowing down a little bit. I think it continues to gain and continues to grow ahead of the traditional players. But the rate of growth may have come down. I think we'll have to wait for another quarter or two to get this situation with some clarity. But it's still growing ahead of the category. You look at our growths. Our growths are much ahead of category. Even if you take 13-14% growths, it's 2.5x category growth.
Category is growing at 6%.
2x category. 2x. So, and I don't know about the category growth. That number is never very visible. But unless their growth is decelerating sharply, and like I said, I have no evidence to support that particular theory, the herbal franchise will be continuing to grow at a much faster clip.
So since you're saying the category growth is around 6%,
volume growth. Whatever I talk about now is volume.
Yeah. Do you think that that category can also grow 8 to 10% since the consumer dynamics are also improving? Do you think that part of the category can also grow 8 to 10% volume?
Yeah, it can grow if the stimulus is there in terms of the discretionary spends, particularly in rural, but also in urban. It can definitely go in double. In fact, we are hoping that categories will start growing, if not in double digits, at least in the high single digits, 8, 9, 10%, for at least the key HPC categories, hair, oral, skin, etc., etc. Because then we'll be able to ride on that tide and grow at double digits. But that may or may not happen. But in any case, we intend to grow much ahead of categories for all the categories in which we participate in.
Fair point. So since the growth is largely driven by market share gain, can you share that what percentage of your domestic revenues has gained market share this quarter?
Well, the big ones have. Hair care is the standout one. Oral care. Shampoos, it doesn't show a gain, but I think, delivering 30% consistently over the last 2 or 3 quarters means that the gains will be there. They haven't been captured in the data, and we'll see the gains happening now.
Well, the category is 8%, we're growing at 30%.
We're going at 30, growing at 8% shampoos, which is actually the best performing HPC category. We're growing at 30%. Last quarter, we grew at 50%. So this will show up perhaps with a lag, because Nielsen numbers are with a lag. I think the only category where we have lost some share is beverages. And that also from a very high base, because we were at 56, which was an all-time high. And it was a peak, historical peak, and now we are 54. So some erosion there, and the reasons for that I have spelled out earlier.
So around 70-75% of the portfolio has gained share.
Yeah, that's true. And Chyawanprash we've gained share, glucose we've gained share, honey we've gained share. I think shampoos, which, like I said, the numbers perhaps don't reflect reality, and then juices are the 2 categories where we have not.
Okay. And last question on the any change in the tax rate guidance
in
FY19?
What guidance?
Tax rate.
Tax rate. No,
I think we would be more or less on the max rate plus deferred tax.
Blended tax maybe even a little bit lower, because the international business, which attracts a lower rate, we do expect the profit growth to be higher than the domestic business. So, but that would be a very minor change.
Yeah, thank you so much, and all the best for the coming quarters.
Thank you. The next question from the line of Abhishek Roy from Stewart and Mackertich. Please go ahead.
Hello, good morning, and congratulations on good set of numbers.
Thank you.
Sir, my first question is regarding your value and volume contribution from rural and urban areas. So can you please share me the details?
For the domestic business?
Yes, for the domestic.
Yeah, the rural franchise grew by around 30%.
12.6.
You have the numbers here?
Yeah. So, rural channel grew by 12.6%. And urban by around 9.2%.
Okay, this is value growth.
Value growth.
Okay, and volume?
Volume split we don't have, but price increases are very small.
If you take a 2.5% price increase component, which is pretty secular both for urban and rural, you can knock off 2.5% broadly from this.
Okay. So, sir, which product contributed more from the rural areas? I mean, so, which is the largest selling products from the rural areas?
I think the HPC categories did very well there. Hair care in particular, hair oils in particular. All hair care, shampoos and hair oils for the oral care consistently well, but that's been doing well in the past. But hair care, which was a little bit sluggish a few quarters ago, is now picked up and gained a lot of momentum in rural.
Okay. Sir, the reason why I ask these questions because many players, like even I say, like Patanjali products, they are actually sold at a discount from the products that you sell in rural areas. And I believe that they have actually had a pretty good market share footfall in there actually. And also few other players, they have come out with their Ayurveda products like HUL, they have launched their Ayush brand, and even Colgate, they have already launched their herbal toothpaste. So do you think that that is going to be a tough competition for you?
Well, there's always been competition, and Patanjali, in fact, which was perhaps a little bit more urban, now urban has come down quite a bit, but he's still trying to build the rural franchise. But I think ultimately our products are also very competitively priced for rural. We have SKUs at 10 rupees and, in oral care and hair care, and you can't go below that. So it's not that we are not competitive in the pricing front. So while we may not be a value player, but we have value offerings, and which we have crafted specifically for the rural market. And so there's no disadvantage per se vis-a-vis the discount players.
Okay. Sir, but this year, what I believe is that volume will be the major contribution to the like FMCG companies, or those are into HPCs categories. So, like if though the raw material prices are going up, so I believe that you will be planning for a price hike as well. But yes. In terms of volume growth, if I see, do you think that your growth will be sustainable, or like do you want to tweak some strategies for that thing as well?
I think our growth will be sustainable. I don't see any evidence of that not happening, unless, of course, there is some rural distress consequent to a poor monsoon or whatever. Those are exceptional circumstances which we don't really put into our scenario. But I think overall our growth should be good. This year, I'm looking forward to this year. I think this year will be much better than what we did in the last 2 or 3.
Okay. And sir, can you just give me an outlook on the raw material price? Because what I see is that crude prices going up, palm oil prices are up. So what is your outlook?
Outlook, well, we are assuming, I think let's take some assumptions. We have assumed Brent of $70. Yes. That's one assumption. Where we are perhaps going a little bit wrong is the dollar, where we budgeted around 65, 56. So not too bad there also. So I think the assumptions are pretty much in sync with the reality. There's been no big surprise here. Even coconut oil, we budgeted at a pretty high level, actually moderated a little bit from that. So our budgets are also factoring in a fair amount of inflationary forces. So I don't think there'll be any unpleasant surprises, but you never know. But some people talk about oil going to 200. Now those are outlying events which I don't think will happen. But otherwise, we are pretty much on top of the inflationary situation.
Okay, so we can expect like say a similar level of operating margin going forward.
Yeah, I think we are committed to maintaining the current levels of operating margin. That is what the endeavor is. We are not seeking to enhance it unless the situation becomes very favorable in terms of both the demand side as well as inflation moderates and the demand picks up. And that's really the sweet spot where you can enhance margin significantly. Now, that may or may not happen, but certainly the margin outlook is something which we are pretty confident about.
Okay. And sir, my last question is regarding your strategy on organic and inorganic growth. So do you have any plan in that part?
Very much so. I think we've just done a couple of small acquisitions in South Africa, so that shows the intent. But the big prize would be doing something substantial in India, and we are still looking at some targets, but nothing really is coming out of it. So the acquisitions, despite the fact that we'll be paying out a substantial amount of cash in the form of a special dividend, our intent in terms of M&A remains completely intact. There's no dilution of that intent. We still have over 2,000 crores of cash in the pocket, and there'll be further build up during this year. So I think we do have the ability and the resources to do acquisitions even of a large size.
Okay. So is there any companies in the pipeline that you are going to acquire?
Well, there always are. I mean, when I say companies in the pipeline, that's almost seems that as if we are just about to sign the check. There's always prospecting happening, and at any point in time, we are looking at 3-4 companies, brands, which interest us. And then, of course, we have to see the intent of the seller and his expectation. And last few years, quite frankly, nothing has happened, and for good reason. The reasons have been largely valuation-driven. But that may not be the situation going forward.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Umang Shah. He's an individual investor. Please go ahead.
Hi, good morning, everyone. My question is regarding the segment reporting, wherein I see a significant movement of capital employed between the segments. So I'll give you one example.
Louder, please. Can't hear you, Umang. Can you speak a little?
Can you hear me now?
Not really.
Umang, can you speak on the handset mode because there's a slight echo from your line.
Okay, so my question is regarding the segment capital employed, wherein I see a significant movement of capital employed between the segments over the year. So, for example, in foods, my Q1 capital employed was around 240 odd crores, which has come down to around 16 crores.
Right.
So, what may be the reason for the same?
So I think what we do is that we have also capitalized, so therefore there is a depreciation involved into this, which dilutes the capital employed. On the other side, there is also the unallocated expenses which are also attributable to that. So that is primarily the reason, and the unallocated capital employed, that is also the factor on that. Yeah.
Hello, so what we are trying to say is that we have capitalized some items, but the expenses are still unallocated. That is why it is not getting reflected in the food segment, but in the unallocated.
Correct, and also this is also net of the unallocated income also, which is arising out of the investments.
Okay, all right. Thank you.
Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. Sir, the rural bounce back that we are witnessing for last 2 quarters, is it also because that the base quarter had a lot of disruption because of GST and DeMon earlier, and the wholesale got impacted the most, which has high share in rural channels? So, or are you picking up signs which are much more sustainable in nature at consumer level as well?
Like I mentioned earlier, there are some green shoots. March numbers indicate some uptick, but overall growth do remain fairly muted. So there has been the benefit of a favorable base, which was more so in the previous quarter, a little bit less so this quarter. But yes, the base is soft. So to get into the high single-digit, double-digit growth, we need to have a better performance in terms of categories, both in urban and rural. It's not that the urban is doing better than rural. It's not. Both are under some consumption stress. And we do expect that it will trend up. It's ultimately, we've seen many cycles of this demand happening. And I do expect that it will trend up sooner rather than later.
Sure. Sure. From today's commentary on Patanjali, what we picked up is that Patanjali is perhaps not as aggressive a competitor as last year or in the recent past. You're reading this based on pricing intensity, distribution expansion, or A&P spend activity. Where you are actually seeing that intensity coming down from Patanjali?
I think mostly in terms of his promotional inputs, advertising inputs and all. So there's much less of that happening this year than it was in the past. Also new product activity, etc., etc. So overall, we're seeing a far more muted performance than what we saw a year ago.
Thanks a lot, sir, and all the best.
You're welcome.
Thank you. The next question is from the line of Amit Kumar from Investec. Please go ahead.
Yeah, thank you so much for the opportunity, sir. Just a couple of questions from my end. One is on the hair oils side. What is the kind of volume growth that we've seen in this particular quarter for Dabur?
Well, I think the volume growth in hair oils will be trending at around 6% or so. I stand corrected, more in the region of 7 to 8%. So again, outperforming the category by around 20-30, almost 50% actually, because the category growth rates have trended around 5 to 6.
Okay, sir, just one question. Given the fact that your hair care growth, value growth is around 9% for this quarter, and shampoos have sort of outperformed. So hair oils, the value growth is just about mirroring the volume growth. I mean, is this because of the change in mix, the smaller
Yeah, there's been no pricing activity in hair oil. So, volume and value is almost convergent.
I mean, is that sort of reflective of the competitive intensity, or is it that you have sort of raw material benefits, so you don't need to sort of
remember, there were big GST-related benefits. There was also the anti-profiteering issues, and there was no reason to take up prices. Margins delivery in hair oils is actually pretty good. So the growth came really from volumes.
Okay, understood. So my second question, in some of the categories, the quarter-on-quarter growth rate, and I mean fairly stable categories. I mean home care, it's as stable as it can sort of get. But we're seeing a 36% growth in the previous quarter, and very muted sort of growth in this particular quarter. Any reason for this kind of volatility out there?
Home care.
Yeah, I think it's largely driven by Odomos, which is inherently volatile. Insect care issues, insect repellents, etc., are driven by how many mosquitoes are there in the atmosphere and how much are they biting. And that's really the outcome in terms of how these categories behave. This is more so in the repellent category, which we rather than the insecticide category. So the volatility is part of the brand's DNA, and you will see great growth happening if there's any epidemic happening.
So there was an institutional order.
Yeah, there was a large institutional order in the base, and we expect to get that order this quarter. Sometimes there's a shift, so we got it last year.
I'm sorry, I missed your commentary a bit. Can you, on this institutional part, can you please repeat yourself one more time?
There was a large institutional order in the base quarter, which did not repeat itself in the fourth quarter of the previous year. And we believe that that's not something which is a lost sale, because the order is still pending, and we do expect to execute it this quarter. So that was one reason. But I think the more important reason was the lack of any kind of epidemics, etc., etc. And that pulled down the growth of Odomos. But otherwise, growth of Odonil and particularly Sanifresh has been very good.
So the reason why I'm a little bit surprised on you're attributing this issue to Odomos is because winter quarter, that's not really a sort of big driver of Odomos any which ways, right? So I mean the previous quarter you had a 36% growth in home care. So very, very clearly, that couldn't have been driven by Odomos. It was, in all likelihood, by Odonil and, Sanifresh. So that momentum doesn't seem to have continued in this particular
quarter. I don't think you should go too much by one quarter's delivery. I think home care did have a great quarter for a variety of reasons, Odomos being perhaps the major one. But that doesn't mean that there's anything structurally wrong. So I think we should get back to good growth in this quarter for Odonil. I'm not too sure about Odomos. Like I said, depends upon externalities. But Odonil and Sanifresh, I'm pretty confident will grow at a strong pace.
Zipper is also doing well.
Yeah, and Zipper will continue to also lead and drive some of the incremental growth.
All right. Understood. Thank you so much.
You're welcome.
Thank you. The next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity and congrats for good numbers, sir. My first question is on juice category. Like, what is the advantage which you as an incumbent have? Is it your distribution or product or your brand? Like, I'm asking because there is well-capitalized and determined competition, like ITC, paperboard, there is benign raw material price, like the margins are at very high levels. So what gives you confidence that you'll be able to hold on to the market share? That's question number one. And second question, sir, is on GST. Any thoughts on e-way bill implementation, any impact which you've seen? And having seen GST implemented for a few quarters now, how has life changed for you? Have you seen any benefits or like shift from unorganized or logistics cost savings, etc.? That's it.
Yeah, in terms of your first question, our competitive advantage in juices, keep in mind that over the last 20 years we've been in this business, our competitors have been the beverage majors, Coke and Pepsi. They've not been small potatoes. They've been all the big organized players. And, of course, there's more of them now. That is ITC and some of the private equity-funded players. So there has been a further enhancement of the competitive intensity, but it's not something which we have not faced in the past and yet managed to get a leadership status here. And behind that is really our supply chain, which is, I think, the single biggest strength, and the value chain. So we have the best margins in the business, and we have the best supply chain in the business. And this is something which we've learned over the years on how to fine-tune the supply chain so that products are freshest in the market. And freshness is a very big driver of sustainable growth. Otherwise, you can get a lot of stuff coming back to you and which you have to just trash. So there's nothing which has eroded there. And according to me, some of these well-funded players, either through internal capital or through external capital, how much can they sustain the burns? So that is also something which you have to keep in mind. This is not a very high-margin business that you can burn a lot of money for till the end of time and, with the expectation of profit coming in. So we do believe that many of these players will lose steam going forward. And, we'll be back to where we were. But even now, we are holding on quite well. While we may have lost a couple of points shares, we do expect that we'll be able to regain them by putting in the promotional inputs, which we can now afford because of the benign prices. On your second question on GST, I think GST net has been a big positive for us. There was that disruption which happened, but it does lower input costs. We get input credit benefits, especially in the services area. Our network improves, the unorganized competition reduces. All these are big positives. They'll take time to play out. The e-way bill, for example, the interstate part has really not been impacting us at all, but there could be some disruptions on the second part, which comes into play from April. But I think now the system is pretty much prepared to deal with the e-way bills. The IT systems are now performing. So I think the process of learning from past mistakes has been now adapted by the people running GST. So the rollout should be quite smooth. Net, over a period of time, starting perhaps this year itself, we will see the benefits of GST emerging, especially in terms of better management of costs.
Yeah. So in logistics or supply chain, have you made any changes after GST? Have you seen any cost savings over the last 1 year?
We made some changes. Now we are embarking on a very major project to completely re-engineer our supply chain. This project will kick off literally now and take us around 15 months to complete. I think that is when we will realize the whole systemic change. Rather than do it in bits and pieces, we want to look at the whole supply chain very holistically, right from procurement to sale, and see under the GST environment which is the best way to optimize it. That, of course, the benefits of that will continue to come throughout the year, but this is a long-term project of big magnitude and big impact.
Yeah. But you are reviewing this because of GST, and in light of GST.
We put it under any case, but now the urgency for reviewing it becomes even more because the whole supply chain architecture has now changed consequent to GST.
Sure. That's it from my side. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Kuldeep Gangwar from KSK Investment Managers. Please go ahead.
First thing, like you mentioned...
So sorry, Kuldeep, we can't hear you clearly.
Is it audible now?
It's better if you can speak on the, the handset receiver. Thank you.
Yeah, hello. So you mentioned about first half FY19 growth of 8% and full year potential growth of 10%. I assume it is volume growth. What is the potential price growth you are targeting for FY19?
These are very indicative numbers, and I think, they're contingent upon, as I keep repeating myself, on the category growth reviving in the second half. So these numbers will happen only if there's a revival of that, of category growth. Sorry?
But these numbers were volume growth you were talking about, no?
Yeah, they're all volume growth. They're all volume growth because the pricing impact will be layered on the volumes, depending upon the inflation situation and other factors. So I think one should really look at the growth from a volume perspective from now on. And this is really what we believe is the situation today. But in the second half, I think the first half visibility is reasonably high, but second half is not that much because of the outlook on the category growth is not very clear.
Okay. But you were mentioning like you're having adequate pricing power as of now, as well as some cost inflation in certain segments. So that means that some price hike will be required, at least in first half FY19. Is that understanding?
Price increase will definitely happen. Now, it could be 2%, could be 5%, I don't know. But that depends upon how much inflation. But when I mention pricing power, it means that we've got adequate amount of pricing headroom to deal with inflationary forces.
Okay. And regarding distribution, so your direct distribution is about 1 billion outlets. What is the optimal direct distribution reach you are targeting, given the cost-benefit trade-offs over there?
See, we believe that we should be at around 1.2 million. The question is, how soon do we get there? We should get to 1.2 million very quickly in case the category growth revive and there is underlying demand which will support the cost of reaching out to these outlets. I mean, it's ultimately the deeper you go, the less is the more is the cost compared to the returns on that investment. So there's no point doing it when the category growths are sluggish. But if they revive, and like I said, I believe they will, then we'll go to 1.2 million, if not this year, then certainly the next year.
Okay. So currently it's 1 billion. That understanding?
Yeah, it's 1.25, 1.3 billion. And we are pretty satisfied with the situation, with the current level of demand, but fully prepared to accelerate it if the demand cycle grows.
Oh, sorry, I couldn't get. Like you mentioned, current is 1 million and you want to reach it to 1.2 million.
1.025, 1 million, something like that. So from there to around 1.2 million is what we should target in the situation where demand revival is reasonably strong.
Got it. Thanks a lot.
You're welcome.
Thank you. The next question is from the line of Riken Gopani from Infina Finance. Please go ahead.
Hi, sir. I just have one question with regards to the international business. Particularly in the GCC, what we understand is the expatriate population continues to decline, and you're seeing more expats, as part of the overall program coming down. So what gives you the confidence that GCC markets and particularly also if you could highlight what is driving the performance during the current quarter in the international markets, and what are the potential headwinds that you see, if any, in the near term towards growth?
Yeah, I think first of all, in GCC markets, we don't target the expats. Indian expats who are residing, and the population of the Indian expats actually shrinking, like you rightly said. We are actually targeting the local population over there, which is the Arabs, and that's the source of our growth is actually coming from. And we had seen a couple of headwinds due to structural macroeconomic changes which actually happened in the entire GCC region, which with the Brent prices going up and the crude prices going up, the economies there are also stabilizing with more stability there. And we've also done some structural changes in distribution in Saudi Arabia, which is responsible for the growth which we've seen in the last quarter. So we see that these growths will continue to happen as the economy improves, and also behind some changes that we've done in our distribution structural changes there.
Oh, okay, so it's more also driven by the distribution changes that you've done. Could you elaborate a little bit as to what basically it's has been there in terms of the changes?
So earlier, what used to happen is the entire market used to be dependent more on wholesale. With so much of macroeconomic changes and the government also tightening and putting a lot of hardships there, the direct distribution becomes more important as against the wholesale. So we had to shift our distributor who was more dependent on wholesale reach to reach out to the interiors to direct reach. So we've actually now changed our distribution to a company which has got more than around 7 to 8 warehouses across the region, and therefore the direct reach is more possible as against indirect. So therefore we changed our distributor partner in Saudi Arabia, which is the largest market in entire GCC. That's why you see a growth of around 85% coming in Saudi Arabia, which we think is sustainable because of these structural distribution changes that we've done on ground.
Fair enough. That's very helpful. Thank you.
All right. Thank you.
Thank you. We'll take one last question from the line of Sameer Gupta from IIFL. Please go ahead.
Hi, sir. Good afternoon. Thanks for taking the question. Most of the questions are answered. Just two questions from my side. The inventories have seen quite a good increase of around 13-14% despite sales being around flattish. So is it related to the changes in our distribution structure over the year, or and going forward, how should we look at this number? And secondly, what would be your capex plans going forward?
Capex. Okay. I think with regard to the inventory on the finished goods has increased primarily on account of changes under the Legal Metrological Act, where the packaging disclosure is required to be changed. So we have prepared this inventory beforehand in order not to lose sales. So that is one of the reasons that you see. And also we have a higher forecast for the current month, for the current quarter. So that has also added to the inventory growth that we have seen as a closing inventory for 31st March. With regard to the capital expenditure, we will have approximated 250 to 300 crore capex for the current year going forward in FY19.
250 to 300, sir, and this would be comprising of any new plant, or this is just maintenance capex that you envisage?
So this will be the capacity expansion in the existing plant that we'll be doing, and we may look at the opportunity for further expansion in our capacity. So it would include that.
But no greenfield plant. This year there will be no completely new plant anywhere in the world.
Okay, because this is a higher capex than that we did in FY18, right?
Yeah, I think it is slightly higher because we have also got approximately 240 crores overall capex in this year.
But keep in mind, all of this will not be expended this year. There may be some carry forward into next.
Okay. Thank you, sir. Thank you for answering.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Ms. Gagan Ahluwalia for closing comments.
Thank you for your participation in this conference call. As always, the webcast of this call and transcript will be available on our website. We'll be happy to address any questions. Thank you and have a nice day ahead.